All right, so we had a big earnings week this past week. A lot of big companies. I'm going to get into the market. I'm going to get into the companies quickly. So as far as the markets go, pretty much everything was up, although nothing crazy. The S&P was up slightly. It started out at 41.39, ended up at 41.69, so up very modestly. On the month, we're actually up fairly significantly. Year to date, we're still up fairly significantly. And from what I can see, everybody and their dog, like I've said before, is expecting a crash, right? A recession. And that's going to happen. I still think we're going to see a correction. But the longer this goes on, the less likely it is to be significant because if it is, it's going to be the longest bear market rally in history, right? I mean, so the longer things go, the less likely it is to happen. I still think we're going to see a correction. Um, just a matter of when. I think it probably will be fairly soon. But again, the longer it goes, the less likely it is to be severe, and that's kind of my position on it. Um, Again, like I said, S&P was up modestly on the week. Oil also was up modestly on the week, I believe. And actually, no, it was down basically flat. Let's put it that way. Up on the month, it is up. 6 months, it's going to be down. Oil, I think, is probably going to chill, but right around this amount for a little while. It'll go down um, if we get a deeper recession. But again, another thing that people need to realize, which I think most people do, but the market is forward looking, right? So even if we do get a modest recession, let's say we do get a modest recession, well, that's probably already priced into the market. So we probably don't see any significant correction. Will see a correction, but it won't be that significant. The only way we're going to see a big crash is if we see a much deeper recession than is expected, right? Um, as far as Bitcoin goes, Bitcoin, um, again, we've seen a recent peak of about 41,000 Canadian, was up a little bit on the week. It's also up on the month, so that's good to see. The next Bitcoin halving is next year. I believe it's in May or very close to this time of year, and that's when we see those big bull markets in Bitcoin. And if it's coinciding with a Fed um, cutting cycle, I think we could see a massive rally in Bitcoin. I mean, another 5 to 10x cycle. So again, I think it gets into the hundreds of thousands. It's just a matter of does it get to 100, 200, 300? Because I could see it getting to 2 or 300 possibly, but I definitely think it's going into the hundreds the next cycle, even in U.S. dollars. So that's something to look out for as well. Again, as far as the earnings from this past week, we had Google was one of the big ones. It's not even the right stock. All right, so Google, they beat earnings 1.17, 1.07 expected. They also announced a share buyback. So again, Google's looking pretty good. As far as one of the bigger tech company goes, I do like them. They're not my favorite, but I do like them. They were up a little bit on the week. Again, they don't pay a dividend, but they are growing nicely. They have a strong balance sheet. Google, of the big tech companies, I think it's solid. Again, their growth is a little bit limited, but again, everything else looks very good. They are considerably below their average price to free cash flow, although they're definitely not cheap. I wouldn't say they're cheap, but they're definitely fairly priced, if not a little bit below. So again, that's Google. The next big one, Microsoft, they also fairly strong. They beat earnings 2.45 per share, 2.23 was expected. So again, Microsoft's a company that I think is definitely overvalued where it's at. I wouldn't be picking it up till probably like 200, maybe 220, 210. Price to free cash flow 39. That's just way too expensive to buy. Although everything else does look pretty good for Microsoft. So if we get a nice correction, I would definitely be picking some up. But again, I don't know if that's going to happen. We're going to have to see a fairly deep recession for that to happen. Visa also beat earnings nicely. Revenue is up. Visa is, in my opinion, arguably the perfect stock, right? Arguably the perfect stock. Again, if we go into the dividends, I like companies that are paying dividends, but typically ones that have a lower dividend yield but are growing them very nicely. Again, their compounded annual growth rate about 16.5%. Again, it's not even 1%, but again, when you're growing at 16% a year, you're not worried about where it's at right now. Again, it's always outperformed the market. Again, if you go back 10 years, again, you'd have a 4.5% yield on cost, right? And again, that's for a company that's growing insanely fast. Again, if we look at its financials here, again, look at these margins, right? 61% free cash flow margin, 50% net margin, 80% gross margin. Like again, like just very, very nice numbers. Exactly what you're looking for in a company, in my opinion. Again, if we look at the valuation, it is a little bit below. Again, it's probably slightly below fair value in my opinion, right? I think fair value is maybe just below 30 price to free cash flow, right? As far as other companies go, Amazon, their earnings were pretty good, but Amazon Web Services is struggling a little bit, and that caused the stock to go down. It was down, actually, I think fairly significantly. It started the week at 109. It's down to just over 105. So again, nothing crazy, but again, down 4%. That's not crazy, but again, it is down. I still like Amazon long term, considering how diversified they are. I still like them long term, although every one of the big tech, like basically every one of the top 10 companies in the S&P, I'm a little bit concerned about, because I think growth is not going to be where it's at over the next 10 years or so. But I still think a company like this is going to do okay if you pay a solid valuation. Again, you got to watch out for the valuations on these companies. Currently at price of sales is okay, but I still think that I'd prefer to get a little bit cheaper. If it went below 100, I think that'd be fair value. MasterCard, again, another company that I prefer Visa, for the simple reason being that I think they're both very good companies, although MasterCard's valuation is worse. Again, 35 price to free cash flow. If we look at the dividends, they're pretty much the same. If we would load here, again, so the growth rate is slightly better, although the actual yield isn't quite as good. MasterCard is growing a little bit better, but Visa is a better valuation, which is why I own Visa. If MasterCard would come down, I would buy MasterCard, but Visa's priced better, so that's why I do have a small position in Visa. Next company, 3M. This is a company that's been hit pretty hard recently. There's been some lawsuits, other things as well. Revenue is up, although profit margins are down. Net income, earnings per share, all down. Again, if we look at the year to date, I think this company's been hit very hard. Yes. So again, it started out at about 122. It's down to 106. So again, it's down. What is it down? 13%. Again, a year when the market's up, that's pretty concerning. It does have a very strong dividend, 5.65%, although payout ratio is definitely a little concerning there at 80%. They're just barely growing it over time. Again, if it corrected a little bit more, I might look at picking it up. But again, I'd like to see what shakes out with the recent events before I would consider it. The next company, Alexandria Real Estate. This is a REIT. This is a company I do have a small position in. I like it for a handful of reasons. I think it's in a good area. If we went into its numbers here again, real estate, it is a REIT. Again, life science, agritech. Again, these are the area. This is a really good area. Like this is an area that's going to grow a lot in the future, in my opinion. Again, FFO yield of 6.1%. So they could be paying a 6.1% dividend. Technically, they don't have to, but they technically could. Current dividend yield just below 4%. They're growing at 6% a year. Again, that's almost. I'd like it if they were growing it a little bit quicker. I'd like it if it was like 8 to 10%. Then it'd be perfect. But that's still a very good dividend, right? And that's an area that I think is going to grow a lot. If we look at its FFO growth over time here, it's the most important metric for REITs. Again, it's literally growing every single year over the last 10 years. It's exactly what you want to see. It's also growing very nicely as well. So again, very nice REIT in my opinion. I really like this company. It's not talked about a lot, but I really like them, and I've started a position, and I will continue to grow that. The next one, Ares Capital. Again, missed earnings by quite a bit, but this is a company that it's going to get hit hard when rates are up. Again, being in the business that they're in, they're going to get hit hard when rates are up, right? Again, currently has a dividend yield of 10.39%. That's why you're buying this company. You're not buying it for that. They did improve their balance sheet recently, which is one of the reasons why I own it. Again, companies like these need to have strong balance sheets, because if they don't, they're probably going to go out of business, or at the very least get hit very, very hard when times are tough. So again, you got to be very concerned about that stuff when you're buying these very high dividend companies, BDCs, whatever it is. Next one, Bank First, again, regional bank. They beat earnings. This is a company I do have a small position in, because I think it's one of the best regional banks in my opinion. Again, they're growing their dividend very nicely. They don't have a high dividend, only 2%, but again, they're growing at almost 14% a year. Payout ratio 27%. So again, they could have almost an 8% dividend if they wanted, right? And they're growing it very nicely. That's exactly what I'm looking for. Next company, Encore Wire. Again, obviously, as their name goes, they make a lot of electrical wire and stuff like that. They beat earnings very nicely. Revenue was down a little bit, and the stock got hit because of that. This is the company that I don't have a position in, but I think it's very intriguing, which is why I keep an eye out for it. They are down a lot. If they can find a bottom, I probably would look at picking up a position in this company, right? Although I wish their dividend was a little bit more. Again, that's just me. But again, that's just me. And they haven't changed it for like 10 years. It's been 8 cents a share the entire time. I don't know why they're not growing that, even if it was slower. Although, again, I think the electrical wire, the demand for that is going to go up over time. You have, the infrastructure bill in the States, and I think a lot of these buildings are going to need to be retrofitted, and that's going to help out a company like this. So again, personally, I am looking to open a position in this company, although I'm waiting until it gets cheaper to do it. The next one, OneMain Holdings. This is another company I do have a small position in. Not really looking to add unless it gets a big correction. Again, very high dividend, although the payout ratio is actually still pretty low, which again is another reason why I like this company. Though, like I said, again, I'm not necessarily looking to add to it necessarily, because I think it is a little bit risky. As far as the earnings go, revenue was up, earnings were down. That's something you do need to be a little bit concerned about when companies are growing revenue but not their other metrics, because that means that there's something going wrong there. Which is why I'm not super bullish on this right now. If we got a correction, I would look at maybe adding a little bit more, but again. Next company, Packaging Corporation of America. This is another company I don't have a position in, although I do find it a little bit intriguing. Revenue, or they missed earnings by a little bit. Revenue was down. They're issuing shares, so that's why I don't have a position in this company, because that's something that's concerning to me. If they got their balance sheet a little bit more in order, if they started to grow a little bit better, then I would be looking to pick up a company like this. But again, not that I think it's a bad company. I think it's a solid company, but when you're investing, you want to pick the best of the best, right? If you want to pick average stuff, in my opinion, you might as well just buy the market. The next company, another company that I want to get a position in, but I'm waiting for it to get a little bit cheaper. PCAR, Packer. I'm not sure if that's how you pronounce it. They beat earnings by quite a bit. Revenue is also up a lot. Again, they build like heavy machinery and stuff like that. Again, solid dividend as well. 1.34%. It's not very hard, but they are growing it pretty nicely, 8.4% a year. The payout ratio is still very low. That's what I like to see. Again, I've repeated that over and over again. I do own some companies that have very high dividends, like One Main Holdings, Ares Capital. I do have small positions in some oil companies, but my favorite companies and the ones that I have the largest position in are companies that have lower dividends but are growing them very nicely, because over the long run, those are the ones that are going to do the best. And again, this is another area where I think there's going to be demand for, which is why I'm looking to start a position in this company. Although, like I said, I am waiting for it to get a little bit cheaper. It is below its 5-year average by a decent amount. But again, I'm still waiting for it a little bit. I think if it got a little bit, if it went into the 60s, I'd probably look at low 60s for sure. 60s, although I'd look at it. UPS, a company I don't have a position in, although it's a good metric to how well the economy is doing, like UPS, Visa, MasterCard, even some of the home builders and the heavy machinery builders. They're good companies to watch at the very least, just to see how the economy is doing as a whole. They beat earnings by slightly. Revenue was down a little bit, although again, when you're seeing a slowing economy, it's not completely out of the ordinary to see that. If this company got cheap, I would definitely look at picking it up, because I think it is a very solid company. It is below its average by a decent amount, although I'd still like to get it a little bit cheaper. Next company, APH. This is a company I don't own because it's crazy expensive, but I do think it's a very good company. Again, beat earnings by a decent amount. Sales is up, debt is down. Although, like I said, crazy evaluation. I'd love to pick up a position in this company, although it is still expensive. I'd like it to get a little bit cheaper still. Next company is Evercore. This is a company I do have a position in. They're like an investment banking company. Beat earnings, but down year over year. So again, it did get hit a little bit on that. Although again, the main reason I like it, again, I think it's growing solid for the industry it's in. Very nice dividend, 12.4% growth. The payout ratio is still very low. Again, if we look at the numbers, it is solid. The growth is a little bit down. That's concerning right now. But again, in a higher rate environment, a company like this is going to get hit very good. Again, very strong balance sheet, very profitable, very good returns. It is a little bit more expensive than it's historically traded. But again, an 8 price to free cash flow, in my opinion, a 9 PE. That's nothing crazy. So, and again, the main reason I'm buying is for the dividend and for that dividend growth. The next one, another one of my favorite companies, Old Dominion Freight Line. It's missed earnings. Revenue was down a little bit, so again, it got hit pretty hard this week. Let's see exactly how much it got hit. So again, it started out at about 355. It was down about 9, almost 10% this week, which is obviously concerning, not what I like to see. But again, in a weaker economy, the transport business it's going to get hurt. It's going to get hurt and it's going to get hit. Although I do think that they still have a strong balance sheet. They're still growing very nicely. Analysts are bullish. That's a good thing. Again, very good balance sheet, very nice growth, very profitable, very good returns. They are expensive where it's at. If you're looking to build a big position, I'd definitely wait a little bit, but I think you can dollar cost average and you'll be all right over the long run. The next one, Popular Bank. Again, another bank that I like. They beat earnings very nicely. Revenue is up, which is good, although it didn't go up that much, right? Again, main reason I love this company, again, very nice dividend, 3.67%, 17% growth, and again, still a payout ratio of 15%. So again, they got a crazy amount of room to grow that dividend. This is the company you're going to have a dividend yield well into the double digits if you hold for 10 or 20 years, which is why I'm buying. The next one, Waste Management, another company I have a small position in. This is a company that is very good for a lot of reasons. Again, nice consistent dividend growth, 8.5%. Again, only 1.7% current yield, but that's not what you're concerned about. This is a very good company. It is boring, right? It is boring, but the good news is that it's not cyclical, right? It's not going to get hit hard when you have a slowing economy, when you have a higher rate environment. It's just going to keep chugging along no matter what happens. Now, The catch to that is it's going to trade at a premium, right? Its current price for free cash flow is 33. So it is a little bit expensive, but if you can get a company, like if this company went below 150, I would love to pick it up because this is a company that over the long run, it's going to outperform the market and it's going to do it in a less volatile way. Next company is Caterpillar, right? And another company that I think it's good to keep an eye on. I don't have a position, but I'd like to get a position because it beat earnings by a lot. I think it's a solid company, always going to have a demand, although it is going to be cyclical. Again, nice dividend growth, 2.2% right now. Payout ratio is still pretty good. Yeah, if this company got a little bit cheaper, I'd probably start slowly dollar cost averaging. But again, this is a company that you really want to buy at the peak of a recession because you're going to get a very nice return then. The last one, Digital Realty, again, another company that I don't have a position in, but again, earnings and revenue were way up for this company, although it didn't go up that much, right? This is an area that I think you're going to see some very nice growth over the long run, and not only that, you're getting a very nice dividend, right? A very nice dividend, almost 5%. They're growing at only just under 4% a year, but again, even if they can grow at 4% a year, you're still going to have a nice yield over the long run. So that is what I wanted to talk about this week. We had a lot of companies release earnings. Overall, it was, in my opinion, positive, definitely leaning on the positive side, not crazy positive, but definitely leaning on the positive side. So anyway, I'm going to leave it there. If you like the video, make sure you hit that like and subscribe if you haven't already, and stay tuned for more.